Good afternoon, everyone. Welcome to the day 10 of the workshop. And we'll be having a discussion on the continuation of our understanding of Goodwill and of its recognition in the books. Okay, yesterday, which was day 9, we introduced ourselves to the concept of accounting for Goodwill and subsequent measurement of Goodwill in business combination. Today, we'll continue from where we stopped to see the other aspect to which we can recognize Goodwill, or the other aspect to which we can see Goodwill coming from other perspective, and what do we consider such to be with respect to the requirement of IFRS 3. Now, I'll share a slide of what we had a discussion last week. We had discussion yesterday, and yesterday at this point we came across something and I highlighted it, and I said we are going to come to its further discussion at a later time, and the later time has come, which is today. Now let's refer to this. Remember, yesterday we had this discussion. Yesterday we had a discussion, and in our discussion, we said it is possible to find ourselves in this scenario where our goodwill may become negative, unlike where it was 35 or 40 or at most, or worst situation is 0. But now we are seeing it that it can be negative. How do you come about this? When we find ourselves in this shoe, what do you consider it to be? How do we treat such? That is what we want to discuss today. Okay, in doing so, we are going to more or less expose ourselves to this problem, and we'll use that problem to discuss all what we need to do. Now, before I will come back and make some narratives, we'll more or less try to use this problem to solve for what we need to discuss today. Now, let me cut the question out. Okay, with my snapping tool, I need to cut this out, and I'll bring it forward here. Okay, the concluding part. Let me copy it. Okay. Now, I want somebody to read the question for us, and from there we'll move further. Who will volunteer?
I will read.
Okay, sir.
Arsenal acquired 70% of the ordinary shares of Manchester United on 31st December 2012, when the balance in the later retained earnings stood at 20 million naira. Statement of financial position as at 31st December 2015. All figures are in millions. Property, plant and equipment for Arsenal 500, for Man United 240. Investment in Manchester United for Arsenal is 180. Current assets, Arsenal 140, Man United 180. The total is 820 for Arsenal and 420 for Man United. Share capital and reserves. Equity share capital at 1 naira per share for Arsenal is 580, and for Man United is 250. Reserves, that is retained earnings, for Arsenal is 200, for Man United is 50. Current liabilities for Arsenal 40, and for Man United 120. So the total equity and liability is 820 for Arsenal and 420 for Man United. Assuming the prevailing market price of Manchester United shares prior to the date of acquisition is 1.04 naira per share.
Okay, thank you very much. Now we are given this position and we are going to treat it the way it is. The group structure is such that Arsenal and Manchester United belongs to the same group. Arsenal owed 70% stake in Manchester United, which implies that we have 30% due to non-controlling interest. The date of acquisition stood at 31st December 2012, while we are reporting as at 31st December 2015. Acquisition took place 2012. These two dates are 3 years apart. Therefore, what comes to our mind first is to say, based on this information, we need to split our reserves. Manchester United reserves. As at the reporting date, 2015. We need to split it into two. Pre-acquisition reserves, which is as at 31st December 2012, and post-acquisition profit or loss for the period. Remember, the reserve of Man U as at today is 50. Therefore, we are trying to split this 50 into X and into Y. What is our X? Our X is the reserve as at the point of acquisition, and we are told that Arsenal acquired 70% stake in Manchester United on 31st December 2012, when the balance in the retained earnings stood at 20 million. Therefore, we come here to say this is 20 million positive. Now, you made positive 20 million, and you have taken it to positive 50 million, which means you have contributed positively to the tune of what? 30 million. That is what it is. Now, if that is the case, I can just put it on this side so that I can see it clearly. Now, I need to determine my goodwill, if any. And in doing so, I will compare my cost of business combination I'll compare it with the net asset acquired as at the date of acquisition. What is my cost of combination? Arsenal's investment.
180.
Arsenal's investment in Manchester United is how much? 180. NCI, if I'm to measure it at A, what is A? A means at proportionate share, because I have the two information there. Therefore, if I'm to use proportionate share of the net assets, what is my X? I'll go and look for it. I'll compare that with my share capital of Manchester United. And what's the share capital of Manchester United? 250.
50.
And what is the pre-acquisition reserve? Pre-acquisition reserve is plus 20, which gives me 270. Now, let's go back to our information here. NCI as at acquisition date, which was 31st December 2012, based on proportionate share of the net assets. What do? The share is 30%. What is the net asset as at acquisition? It is 250 and 20, which give us that 270. And that gives me 30% of 270. It's 81 million. Which means this is 81 and have 261. Now, what do you find ourselves in? That we have a negative amount of what? Of 9. Which means this goodwill is negative. Now, what do we mean by negative goodwill? We'll discuss that. And how do we treat such? We'll also discuss. But before we discuss that, let me quickly go ahead to also treat this in light of, okay, let me finish this. I'll also now replicate it for fair value of NCI. Okay, if we have to fair value NCI, we'll come to that. Okay, now what is my amount of NCI as at reporting date 2015? It is my NCI as at acquisition date, which is 81.
Post-acquisition profits.
Plus this 30 is a return in which part of it goes to NCI. Share of post-acquisition profit, you have 30%, and you take 30% of 30. That gives us 9. All in all, it gives 90. What is my consolidated reserve? As at the reporting date, it is the reserve of Arsenal. What is the reserve of Arsenal? 200.
100.
Plus share of post-acquisition profits, which is 70% in this case because of this, multiplied by 30 million. And that gives me what? 21. Okay. That should give me my position. Now let me replicate the same thing. And by copying this, and let me do that for the second method. Okay. Okay. Now the second method. Let me clean this. Now the second method. Is B, which is at fair value of equity instruments. Now, Arsenal's investment still remain at 180. But the fair value is not known. Share capital of Man U still remain at 250. And pre-acquisition reserve from our analysis here remain at 20. And I have 270. Now, what do we need to do to determine NCI based on acquisition date fair value? And in that case, what we need is the market price per share multiplied by the number of shares NCI has in Manchester United. Now, they've given us information about the market price. They said the market price of Manchester United shares prior to the date of acquisition was £1 4 kobo, which means I'll come here and say £1 4 kobo multiplied by how many shares are held by NCI in the subsidiary. If you go by the information, we are not giving information about number of shares. But from this information here, and given that my share capital of subsidiary is 250, I can work out my problem. How do I work out my problem? I can come here and simply say, the number of shares in Manchester United is equivalent to the share capital divided by nominal price. In doing so, what is the share capital? 250 million naira. What is the nominal price? The nominal price is £1 per share, which is the authorized price per unit of share. That gives me 250 million shares, of which NCI shares is equal to the stake of NCI. NCI has what stake here? 30%. It is 30% of 250 million shares, which should give me 75 million shares as the total number of shares of NCI. I bring the 75 million shares here. What does that give me in naira? £1 4 kobo multiplied by 75 million shares will give me 78 million naira, which is my X. And this gives me 258. Also, for the second time, this is giving me negative, similar to what I had before. Only that what I had before was negative 9. Negative 9. Now I'm having negative what? 12. Which means here also, the goodwill is what? Negative. The question then is, how do we treat negative goodwill? That is the main question. How do we treat a negative goodwill? How do you treat a negative goodwill? That's the question. We'll come back to answer that question. But here, my NCI is not 81. But here, my NCI is what? My NCI is 78, which is what I got here. And 78 plus 9 is what? 87. Now, let us come back here. How do we treat negative goodwill? Now, it takes us back to where we were before. Shegun, you do us a favor.
Okay.
You help us read out this, and we'll take it off from there. Accounting for gain or bargain purchase. Can you read it?
In some business combination, but usually in an extreme case, the consideration transferred and transferable may be less than the fair value of the net assets acquired. This situation results in negative goodwill, which is often identified and recognized as a gain from a bargain purchase transaction. IFRS 3 revised suggests that since arm's length business acquisition transactions will usually favor neither party, the likelihood of the acquirer obtaining a bargain is considered remote. The standard IFRS 3 revised apparent instance of bargain purchase transaction giving rise to a gain from bargain purchase are more often the result of measurement errors, which include the measurement of the fair value of the consideration transferred and those transferable, and the fair value of the identifiable assets and liabilities of the subsidiary upon acquisition. Furthermore, gain from a bargain purchase can also be derived from the risk of future losses recognized by both parties and incorporated into the transaction price. IFRS 3 revised requires that the fair value of the consideration and the fair value of net assets acquired are reviewed, including contingent liabilities that are probable at acquisition and of which the fair value can reliably be ascertained as of acquisition date, and checked carefully to ensure that errors have not been made. After the review or assessment is completed, and indeed the fair value of identifiable assets acquired, identifiable, and indeed the fair value of identifiable assets acquired, net of all liabilities assumed, exceeds the fair value of total consideration transferred, then a gain from a bargain purchase will be acknowledged and immediately taken into profit, that is recognized directly into the income statement of the group.
Thank you very much.
Okay.
Now, what is the summary of all of this? We'll go back to our noteboard. First, when negative goodwill arise, we are worried. Why? Because it's a rare occurrence. What we are simply saying is that we have offered lower than the value, which is the worth of a business. And if you have done that, you ask yourself, are you sure that you are truly offered lower than the value? Are you sure you even know what the value of the business is? And therefore, what do we need to do? It's for us to sit down and carry out a reassessment. Though it is possible for such occurrence to exist, where you pay less than the value of what you took over. But before you conclude, you need to carry out a reassessment to see that actually you paid less. In practice, you can pay less, especially when you are buying a struggling business, where the original owners are willing to sell at a discount for them to move on. You can say now, but it is more often to pay more than to pay less. That's why IFRC says, when you find yourself in this situation, do the following things. One, carry out a reassessment of the consideration you have offered and ensure that all of the consideration have been measured at fair value and they have been appropriately measured. Second, review the net asset you claim you acquired, so that you consider all identifiable assets and liabilities, including contingent liability, and ensure that all of them have been taken into consideration, so that nothing is left unturned and that you have measured these assets and liabilities appropriately at acquisition date fair value. Now, when you have done this reassessment and you find yourself in a situation that these differences, which resulted in a negative goodwill, still exist, what then you do, based on the requirement of the standard, is that we now conclude that such is a gain made at day one of the acquisition. And such a gain made at day one of the acquisition is otherwise known to us as a gain arising from a bargain purchase transaction. The next question then is, what is a bargain purchase transaction? A bargain purchase transaction simply represents transaction in which the acquirer, which is a parent entity, engage in deep negotiation with the existing shareholders of the subsidiary who are ready to surrender their shares in such a way that is able to pay less than the worth of those shares. And if that is a fact, it then means that the acquirer, which is a parent, has made that gain at the point of acquisition. Thereby, such gain should be recognized in the group profits. And such gain, regardless of the methodology you have chosen to measure non-controlling interest, will be solely attributed to the parent, which means issue of measuring NCI at fair value or proportionate share does not impact or determine the recognition of such gain as duly attributable only to the parent, who was the only party to the negotiation. Because the negotiation took place such that the parent took advantage of the existing shareholders that surrendered their shares, in which NCI are not part of. NCI are existing shareholders that did not surrender their shares for acquisition by the parent. Therefore, they are not involved in such a negotiation that created a profit to the parent between transactions consummated by the parent and the existing shareholders in the subsidiary who surrender their shares as at the acquisition date. Thereby, we conclude as thus to say the difference termed negative goodwill will be recognized upon acquisition as a gain on bargain purchase transaction in group profits. And such is only or solely attributable to the parent in the business combination. Therefore, on that premise, what then we do is that gain on bargain purchase, which is what we term this negative goodwill to be, of 9 will be a credit to the retained earnings. And a credit, forget this sign is just in the order of which you present it. A gain increases your reserve, a loss reduces your reserve. Therefore, ultimately, this is what? 230. In scenario B, the gain is 12. Therefore, we also come here to recognize a gain on bargain purchase of 12. In this case, we have 233. And that is how we account for negative goodwill whenever we come across it. Now, what does our balance sheet look like? Let me pick the balance sheet we used yesterday. Let me just copy that. Okay, and clean it up. Okay. Now, let me copy the question, yeah? Okay. Now, the group belongs to Arsenal. Okay. Now, what's our PPE? We have 500 and 240. That is 740 on both occasions. Goodwill does not arise in this case. because rather what we had was a negative goodwill, which has now been treated as a gain and has been closed out to the profit, which means this is no longer required. Nothing like goodwill in this case. Rather, there was a gain on bargain purchase. Therefore, what is our current assets? Our current assets is 140. I believe you are seeing my screen. And 180. Can you see my screen?
Yes.
Okay. That is 320. Add it together, 1060, 1060. Share capital is Arsenal alone, and that is 580. Consolidated retained earnings. In the first case, we had 230. In the second case, we have what? 233. 230, 233. This is 810, 813. In this case, it's not Pali, but it's what? Arsenal. What is NCI? In the first case, NCI was 90. In the second case, it was what? 87. 90 and what? 87. Our total equity is 900 and 900. What's my current liability? 40 and 120, which is 160. And that is how we wrap it up. Any question at this point? Any question at this point?
I would just like you to explain again the reason why we attribute the total gain in bargain purchase to the parent and not to the NCI.
Okay.
Yeah, I understand the calculation, fine, but if you can just explain that to me, I will appreciate.
Okay, thank you. Now, we have many people on this platform now. Imagine you are Arsenal as a company. Myself and every other person in this platform, we are the existing shareholders of Man U.
Okay.
Now, you came to say you want to buy over Man U. And you spoke to us, but only few of us, that by aggregation, our number of shares is up to 70% that are willing to sell.
Okay.
And we are willing to sell because we have seen that the performance of Man U since Ferguson left is jingling. We just feel like, okay, it's an opportunity for us to pick it up and go. Now, in the process, probably we are much more interested in selling than you buying. The only incentive for you buying is that we are not selling at a price that is below what the real worth is. And you took that advantage. It's okay, you guys, okay, I'll buy it from you at $1.04 or at any price you agree. Now, by the time you buy, you now gain 70% stake in Manchester United as a new shareholder. Remember, we have some other shareholders that make up 30% that they did not sell.
Yes.
Now, you and the existing shareholders are those that enter into that transaction. And they are the ones that sold to you at ridiculous price that make you to have that edge or paying lower than the value.
Yeah.
The question then is, you have paid 104 instead of 110. That gain from that differential, when you accumulate it, who is it due to? Will it be due to you and also due to those that did not sell their shares at all?
Yeah, it will be due to me.
Exactly. Those that do not sell their shares will become a non-controlling what? Interest in you. Therefore, they are not party to that negotiation. Neither are they party to that transaction that gave rise to that gain, which you have recognized as the one profit. Have that made sense?
Yes, perfectly.
That is just it.
Yeah.
That's it. Now,
hello, me was sorry. Hello? Can you hear me?
She took me to pen, don't she?
Hello, me was.
Okay, don't freak out. Close the knocking.
There's serious noise coming from your side. You have to leave that side. Okay? Or you send us a chat. Okay, any other question?
Hello, Mr. Muiwa, I have a question.
Yes, sir.
Okay, please, you mentioned the other time the way we treated the gain on a bargain purchase, and you said loss on a bargain purchase. Is there any situation whereby we would have a loss on a bargain purchase?
No, I didn't say loss on bargain purchase. I said when you have a gain,
yes,
even though it's showing negative there, you won't go and deduct it because it's not a loss. It's a gain, which a gain add on to retained earnings. That's what I was explaining.
Okay,
and this
sir.
is a bargain purchase.
All right, sir. Thank you.
Yeah. Okay. Enaro, if you can respond to send us a message via chat, we'll answer you. Now, let me take you back to our material. And let's go back to the end of chapter. In each end of chapter, we have summaries and we have questions. Okay, now, Madam Tomilayo, can you summarize all what we have discussed on goodwill and gain on bargain purchase from what is on your screen? I'll enlarge it for you.
Okay.
Can you read it up?
Okay, summary of chapter 5. Goodwill may be considered as the commercial advantage an entity or a business has over its competitors. And as such, every investor may be willing to pay for it. In a business combination, goodwill may result from the fact that an investor may have offered purchase consideration of which its fair value may exceed the fair value of the identifiable net assets acquired, including assuming contingent liabilities that can be measured at fair value upon acquisition. Number 3, only a purchased goodwill, which may have resulted from the acquisition of a business in a business combination that is required to be recognized under IFRS 3 as non-purchase or inherent goodwill, are not permitted to be recognized in IAS 38, which is intangible assets. Number 4, goodwill recognized on acquisition may be recognized in full, that is, both portions attributable to the parent and non-controlling interest are recognized, or in part, that is, partial goodwill, where only the goodwill attributable to the parent stake is required to be recognized. Number 5, goodwill is not permitted for amortization based on the premise that it does not have a predetermined life. Hence, it has an indefinite life. Rather, goodwill should only be tested for impairment at least once a year. Number 6, impairment losses on a partial goodwill are only attributed to the parent, while the impairment losses on full goodwill are required to be attributed to the parent and non-controlling interest in the proportion the parent and the NCI share profit or loss. Number 7, gain on bargain purchase is recognized when negative goodwill represents an outcome of the acquisition date accounting of a business combination. The gain on bargain purchase is to be credited to the profit or loss upon acquisition and is only to be attributed to the parent as NCI is not a party to the transaction that may have given rise to such. That is on the day one gain. Number 8, a negative goodwill is only recognized as a gain on bargain purchase if and only if a review or an assessment of the fair value of the consideration and the fair value of net assets acquired are, including contingent liabilities that are probable at acquisition, and of which the fair value can reliably be ascertained as of acquisition date. That is, are confirmed to have been appropriately measured and errors have not been made. Sorry, I can't see. And errors have been made. Otherwise, necessary adjustments may be required.
Now, with this summary, does it speak to, is there anything there that you have not grabbed in the course of our discussion yesterday and today? Is there anything?
Yes. I think the only thing that I think we need a further explanation is on the side of inherent goodwill and purchased goodwill.
Okay, remember we discussed yesterday, we can't be discussing inherent goodwill under business combination because remember, business combination deals with acquisition of a business. And that is when we talk about purchase because you acquire that goodwill. Okay, when we get to discussion on intangible asset as a whole, which I mentioned yesterday under IS 38, we'll be discussing every form of intangible asset and which one qualify for recognition and which one do not qualify and why. And probably when we get there, you now try to understand what form of goodwill exists. Is it purchase goodwill or is it non-purchase or what we call inherent goodwill? And why do we not recognize inherent goodwill as opposed to recognizing purchase goodwill? Those questions will be answered at those points. Do you get what I'm saying now?
Yeah.
And that's why you understand that one of the beauty of this program is that you will only be all-rounder where you have been able to demystify every aspect of the standard. Because it is all of the aspect knowledge that you now put to use for every business. And that's why you can't be a prolific accountant or a finance professional if you don't have more than average knowledge of everything, because everything is what businesses are exposed to, in which you superintend upon. Does that make sense?
Yes.
You can't be a CFO and say, areas of share-based payment, I don't know it. And your business is engaging in share-based payments. Therefore, what do you do? Are you getting it now?
Yes.
Therefore, we are not here to discuss, for example, that say, okay, this area, I don't like it, this area. No, when you are a CFO, when you are an auditor, when you are in management position, which relates to finance, you are the person that has the knowledge or expected to have knowledge of all as it impacts your finances in a business. Whether you now rely on the work of experts and the likes is secondary, but to take responsibility. Any other question?
Good afternoon, Mr. Muyiwa. Please, sorry for drawing you back a little. Yesterday, the network down here was very bad, so towards the end, I couldn't participate. So please, I've read it up about the impairment of goodwill, but I just want you to give me a brief, a kind of summary so that I've read it up so that to further buttress my understanding.
Okay.
You can do that for me, sir.
Yeah, the danger there is that we may not be able to do that because there's no summary other than going detail and granular. And that's the beauty of why we record all the session. And the section recording was made available where we discussed extensively. What I would advise is that until you watch that session, because I know you have not watched it, madam. Have you watched it?
Actually, I was tired when I was watching it, but I just read up from the book
Yeah. You need to watch it. When you watch it between today and before next week, you find out that you have little or no question.
All right.
And when you have question, we'll be on the same page where we now have to use practice to narrate it.
All right.
Because there were extensive discussion that we did and what we demonstrated in having understanding of it. And that's why you find out that I ensured that not later than 2 hours after we complete the session, I immediately put up the recording so that anything you have missed, you might take it as an opportunity to grab it as soon as practicable.
All right. Thank you, sir.
Yeah. Okay. Today, we will be looking further at chapter 4. No, chapter 3, sorry. Okay. Akin Folarin, can you more or less introduce us to chapter 3 so that I can take it off from you?
Yeah, good afternoon. Topic chapter 3, accounting for investment in parents. Separate statement of financial position. Let me read out the introduction. This chapter will introduce the reader to different forms of purchase consideration available in business consideration. Within the chapter, the cash consideration, share exchange or considerations, asset transfers, issues of the debt instrument, deferred and contingent considerations will be evaluated in their accounting implications and and contingent consideration will be evaluated and their accounting implications considered. The readers will further be introduced to the need to first recognize investment of the investor in the investee in its separate financial statement prior to any consideration for the consolidation of the subsidiary final result with that of the parent. In conclusion, the subsequent effect of the accounting for changes in the value vis-a-vis the unwinding of discounts inherent or embedded in the present value of the deferred and contingent considerations, that is, other than those related to equity consideration, will be considered in their details.
Okay, now let me summarize it here. What we are saying is this. Prior to the requirement to consolidate, a subsidiary, how should the parents account? What account means recognize its investments, its equity investment in the subsidiary in its own books. What is the book of the parents now? His own book is what we know as its separate financial statements. That's the question. How should the parents Let me give an example. Shegun, in the example I did earlier, you are Arsenal that has now come to acquire 70% stake in Manchester United. When you acquire Manchester United, how do you first reflect that investment in your own financial statements, which you classify as separate financial statement? That's what we are talking about. And to do that, we are going to rely on IAS 27, which talks about separate financial statements. Let's start like this. What is a separate financial statement? Who can answer that question? Have you come across it before, a separate financial statement? I'm waiting.
Okay, what I understand by separate financial statements is a financial statement that is not consolidated. It's a financial statement of a legal entity, which is different from a consolidated financial statement of parents and subsidiary. So in a nutshell, is a financial statement of a legal entity representing the transactions and events of that entity within a specified period of time.
Can you break it down in small language?
Okay, for instance, every company prepares their periodic or year-end financial statements, and whatever they prepare, the company's accounts is their separate financial statement. Even if it's a group, if it's a group of companies, maybe consisting of the parents and maybe 3 or 4 subsidiaries, each of the parent and each of the subsidiaries will still have to prepare their separate financial statements before it is being consolidated into one. So those financial statements prepared by the parent and the 3 subsidiaries are known as separate financial statements.
Okay, can any other person contest that?
Okay, so I'm not contesting. I just have something like an example. Like he said, having the other books of the company will show the do. So I have one example, something that came to my head is, for example, you will find a financial statement of a company now that shows investment in so. Just like the financial statement we've been using as example. So that is a kind of separate financial statement. At times it could be maybe a debt instrument in that will reflect in another person's book. I think that is the kind of example I want to make.
Okay. Okay, but I've not gotten something satisfactory. But let me share something with you before we move on. Kevin, can you read here what a separate financial statement is in line with IAS 27?
Okay. IAS 27 has the objective of setting standards to be applied in accounting for investment in subsidiaries, jointly ventures, and associates when an entity elects or is required by local regulation to present separate, non-consolidated financial statements.
Now, key definitions. Now, define separate financial statements.
Okay. Financial statements presented by parents, that is.
No, start from the beginning. Separate financial statement now is.
Separate financial statement is the financial statement presented by a parent, that is an investor with control of a subsidiary, an investor with joint control of or significant interest over an investee, in which the investments are accounted for at cost or in accordance with IFRS 9 financial instruments.
Now, let me deduce what it means. What it simply means is that when we talk about separate financial statements, we are referring to first a parent entity that will have presented a consolidated account or group account, but its local regulations still require such entity to present its own financial statements separately from the group. For example, in most jurisdictions, especially in the developed world, there are no requirement to prepare separate financial statements. That entity is to prepare group accounts. But there can't be group accounts without your own individual accounts. Therefore, your own individual account as a parent that prepares group account is what is characterized as separate financial statements. And such adds a leeway to which you recognize investment either in subsidiary in which you control, either in an associate in which you exert some kind of influence, or either in a joint venture in which you have a joint control over. Because the accounting methodologies differ. For a company you have control over, which is your subsidiary, you consolidate, which is what we have been doing. For a company you have some kind of influence over, which is your associate, you equity account for it, which we'll come to later. And for a joint venture in which you exert joint control, you also use equity method. But we are saying that instead of using all of these, in your own financial statement other than the consolidated, you are allowed to recognize such investment either at cost or at fair value, which is in line with IFRS 9. Which means separate financial statement does not deal with a subsidiary. It deals only with an investor who is seen as a parent that still has responsibility of preparing group account. His own financial statement will be considered as a separate financial statement from the group. A subsidiary can never have a separate financial statement because he doesn't even have responsibility to prepare any other account other than his own account. Which means he doesn't prepare group. It is the entity that prepares group account that you can classify or characterize its own individual financial statement as a separate financial statement. And the essence and emphasis is because in the separate financial statement, an investor is required to account for its investment in a subsidiary, an associate, or a joint venture. At what?
You can't see the screen.
Okay, I didn't share my screen, sorry. As I said earlier, an investor is required to account for his investment in a subsidiary or an associate or a joint venture at cost, which is in line with IS 27 exception, or at fair value, which is in line with IFRS 9 on financial instruments. Now, what is cost? Cost is the initial fair value of a financial instrument or of an equity investment as at the time such investment was made, which is not subjected to changes up to date. Because at a time it was fair value, because that was the price you pay. But today, the value remains the same. That's what makes it a cost, historical cost from that perspective. But fair value means at every reporting date, the value will change based on what is currently obtainable in the market over, which is in the active market. And that's what fair value entails. Okay, now to do this, we need to understand that what are the form of considerations? Forms of what? consideration in a business combination? What it means is that for you to acquire 70%, 80%, 60%, 100% in a subsidiary or in an associate or in a joint venture, you need to more or less offer a consideration. The consideration can be in cash, which means whether bank money or cash, physical cash money or Bitcoin or anything you call it, you have made a payment. Or it can be in kind. In kind means you could take either of a form of share exchange or what you call share consideration. It can be in form of asset transfer. It can be in form of debt, financing. And it can be a combination of cash and shares or more. And others may include deferred and contingent considerations. And that is what we want to discuss. Okay, let me share this screen.
Please, can I quickly ask a question?
Yes, sir.
Yeah, can you tell me what it means by single financial statements? Because I think I was mixing it up while defining the separate financial statements. Maybe I was talking about single financial statements.
Okay. First, we barely mentioned this. In technical terms, there's nothing like single financial statement. What we have is financial statements, which means it's a financial statement of just an entity. Even though you can describe it from your own perspective as single financial statement, but I'd rather use the word or phrase financial statement of a single word entity, which is otherwise known as unconsolidated financial statement, which is the financial statement of a single entity.
Okay.
Or simply put, financial statements.
Right.
Is that okay?
Yes, sir.
Does that address you?
Yes, yes.
Okay, now, Shegun, I want you to read through to corroborate what I've discussed so far now.
Okay. Accounting for investment in parents, separate statements of financial position. IS 27, separate financial statements, requires an entity preparing separate financial statements to account for those investments at cost, equity method as described in IAS 28 or in accordance with IAS 39 or IFRS 9 financial instruments. IAS 27 separate financial statements contains accounting and disclosure requirements for investments in subsidiaries, joint ventures, and associates. when an entity prepares separate financial statements. Separate financial statements are those presented by a parent, that is an investor with control of a subsidiary, or an investor with joint control of or significant influence over an investee, in which the investments are accounted for at cost, equity method as described in IAS 28, or at fair value in accordance with IAS 37 and IFRS 9 financial instruments. Technical note: financial statements in which the equity method is applied are not separate financial statements. Similarly, the financial statements of an entity that does not have a subsidiary, associate, or joint venture's interest in a joint venture are not separate financial statements. Transactions and events accounted for as business combination. A business combination results from the occurrence of a transaction or other event that results in an acquirer obtaining control of one or more businesses. This can occur in many different ways that include the following examples individually or in some cases in combination: transfer of cash, cash equivalents, or other assets, including the transfer of assets of another business of the acquirer, acquiring of liabilities, incurring of liabilities, insurance of equity instruments, providing more than one type of consideration, or 5, by contract alone without transfer of consideration, such as a an ac- when an acquire business repurchases enough of its own ordinary shares to cause one of its existing investors, now the acquirer, to obtain control over it. B, there is a lapse of minority veto rights that had previously prevented the acquirer from controlling the acquiring in which it held majority voting interest. And C, an acquirer an acquirer and acquire
And
an
acquiring
acquiring
is missing.
contractually agree to combine their businesses without a transfer of consideration between them.
Thank you. Now, this will now lead us to exposure towards each of the considerations I've mentioned earlier. Now, let's look at the first scenario where cash was a consideration that was transferred. That is, how do you get that 70% you invested as Arsenal in Manchester United? You pay cash. When we say cash, we don't necessarily mean physical cash you put on your paper cash, no. That is, you made payment, whether by bank instruments or by cash, but you are paid for what you acquire in money terms, which is a depletion of your cash and cash equivalent position. Now, in that case, I want you to continue. Let us look at the first scenario, scenario A. Can you continue, sir?
Scenario A, cash consideration. Given the statement of financial position of Parent PLC, immediately prior to the company investing in the entire share of Subsidiary Limited on 31st December 2015 at a cost of 50 million naira. And this investment is yet to be accounted for in the financial statements of the investor, as shown above. Statement of financial position as at 31st December 2015. All figures in millions of naira. Property, plant, and equipment is 300 million. Current assets, 120 million. Total is 420. Share capital and reserves. Equity share capital at 1 naira per share, 250. Reserves or retained earnings, 90. Current liabilities, 80. And the total is 420 million naira. Suppose a consideration of 50 million naira offered in a cash consideration to the equity holders of Subsidiary Limited, which is made upon acquisition. The investment should be recognized in the separate financial statements of the parent as at the date of acquisition based on the provision of IAS 39 and IFRS 9. The fair value of the cash consideration of 50 million naira should be recognized in a financial asset in the separate statement of financial position of the parent based on the following accounting entries: debit investment in subsidiary and credit bank a component of current assets by 50 million naira.
Now let's stop there.
Okay.
If we look at the question, what is said is that this is the financial statement of the parent prior to the acquisition of the subsidiary. As at this point, he has never had anything to do with the subsidiary. But what he has done at this point is that he has now purchased stake in the subsidiary for 50 million naira, which he has made cash consideration. We're now saying, how do we reflect that acquisition in the financial statement of the parent as at the point of acquisition, before we even think of issue of consolidation? If you check where we are coming from, every financial statement of the parent will have recognized investment in subsidiary. But this has not, because this is saying that, okay, if you are the accountant, when they are just investing in the subsidiary, how do you bring that subsidiary investment into your books before you even talk or proceed on consolidation? And that is what gives back to the fact that we ask ourselves, what is the worth of the cash consideration? Is 50 million as at when it occurred. That 50 million, you parted away with your cash, which means your bank balance will be depleted.
Mhm.
The depletion of your bank balance is a credit entry of 50 million. And something is coming to replace that, which is the investment you are bringing in the subsidiary, which we recognize as a debit of 50 million. Invariably, what did you see? Let us now compare the two. Let us compare the two balance sheets and see what it looks like. Property, plant, and equipment is unaffected, it's still 300. But between property, plant, and equipment and current assets, we have investment surfacing at 50 because of this entry we have passed. And current assets depleting because bank balance is a component of current assets. And therefore, a credit to a bank balance or bank position is a reduction of 50 million, which give us 70. All in all, our assets still remain at 420, and our share capital reserve and coin liability is unaffected by this. And therefore, this is a new financial statement position as at when the subsidiary was acquired. This is the financial statement we now present as, okay, combine or consolidate with that of the subsidiary. Now, the next question is, what if it is not shares?
What if it's not cash?
Sorry, what if it is not cash? But now we want to do share exchange. What do we do? Therefore, we move to the second level.
Hello, sir. Can I quickly ask you a question, please?
Yes, sir.
Okay. In this case, looking at this financial statement, when we made the cash consideration, is it the cash consideration that the IFRS is referring us to assume it is a cost? You assume it's cost, that it was made in cost now. I mean, this 150, 120.
50 million you paid is the cost of what you bought.
As at this time, okay.
Yes.
All right, sir.
Okay, Shegun, can you continue? Scenario B, what if it's share consideration? What will happen?
Scenario B, share consideration or share exchange. In some instances, consideration can be offered in form of shares exchange or transfer between the shareholders of the parent, that is acquirer, and that of the subsidiary, the acquiree, as opposed to cash consideration, which was earlier considered in the illustration above. The recognition of the shares consideration will be measured at fair value based on the proposition of IAS 39 and IFRS 9. The fair value of the shares consideration of 50 million, hypothetical, being 40 million shares at the market price of 1 naira 25 kobo, should be recognized as a financial asset in the statement of financial position of the parent based on the following accounting entries: debit investment in subsidiary by 50 million, credit equity share capital by 1 naira multiplied by 40 million shares, giving 40 million naira, credit share premium by by 25 kobo times 40 million shares, giving 10 million naira.
Now, what is it saying? It's saying that let us go back to our first question, that instead of this cash consideration of 50 million, which you consider as cash consideration of 50 million, rather what was given is not cash. What was given is that shares worth 50 million. And shares worth 50 million is equal to 40 million shares. And the market price of the share was 125 kobo, which means it's trading at a premium of 25 kobo. It is 125 kobo multiplied by 40 that gave us the value of 50. And I say, how do we account for that? What this simply says is that instead of the company should use its cash to pay, the company now decided to issue more of its shares in exchange for the shares it's going to take over from the existing shareholders of the subsidiary. Which means doing so means as you increase your equity by the number of 40 million shares you issue, the component of equity that is affected by 1 naira is the share capital because that's the nominal price. The component of equity that's affected by 25 kobo is the share premium because of the premium in excess of the 1 naira. Everything make up this 50 million that is used as in-kind consideration for the acquisition of the subsidiary. Hence, what did you see? You now find out that investments still come up at 50 million. Nothing affected our current asset because you never paid cash, but rather your share capital increased by 40 million and your share premium increased by what? 10 million, which represent the accounting entry you find out here. The accounting entry here, 40 and 10. And that is what resulted into increase in share capital and increase in share premium. And this represents our new balance sheet, given that it was an exchange of equity. Any other question?
Is it ever possible to acquire the shares of a subsidiary at a discount? Can that ever happen in practice?
It is possible. You can acquire shares at any price, depending on, and at a discount will probably give you edge to have a gain on bargain purchase. Okay, let's see a situation where you acquire based on partly cash and partly shares. Scenario C.
Okay, scenario C, combination of cash and shares considerations. Furthermore, the combination of cash and shares considerations can take a position in the acquisition of a subsidiary. The combination will be treated in consonance with earlier treatments above as it relates to cash consideration and share consideration. Assuming partly cash of 20 million was made, while the remaining as shares or equity consideration, the fair value of the cash consideration of 20 million naira and shares consideration of 30 million naira, hypothetical, being 30 million shares at the market price of 1 naira, should be recognized as a financial asset in the separate statement of financial position of the parent based on the following accounting entries: debit investment in subsidiary by 50 million, credits equity share capital by 30 million, credits bank or current assets by 20 million.
Okay, if you look at here, yes, you agree to buy it for 50 million and you agree to pay 20 million cash and the balance in shares. The shares you issue are 30 million shares and the market price was 1 naira, which coincidentally is equal to the nominal price of 1 naira. That's why there's no premium here. Now, as you recognize investment of 50 million, you will deplete your cash position by 20 because you paid 20 out of your cash and you issue additional shares to make up the balance of 30 million. Therefore, what do you see here? As you recognize 50 million investment, you recognize 20 million reduction in your bank balance, which is a component of current assets, and you recognize increase in your share capital for the additional 30 million shares you issue at full market price of 1 naira, which is equal to the nominal price of 1 naira. And that is how we have this. And this is how your balance sheet will look like immediately after accounting for that. Now let's look at the next scenario. Here we said, what if it is a debt financing? What is a debt financing? You borrow money to acquire a business, or you acquire a business and instead of giving them cash, you'll be owing them and you convert it to loan, which means existing shareholders that you took over their shares will now be a debt holder in your company. Either of the case is still talking about debt financing. Okay, can you read up this?
Okay, scenario D, debt consideration. The investor or acquirer can also explore the opportunity of issuing debt securities towards raising cash for the acquisition or investment in the investee company. The debt can either be issued outrightly to the interested public or investors, or issued in exchange for shares in the investee company, but the latter is rarely common. The debt will be recognized as a financial liability in line with the requirements of IAS 39 and IFRS 9, and simultaneously recognize the investments made with this cash proceed from the issuance of debt securities in the subsidiary in a separate financial statement as financial assets. Given that a 10% convertible debt was issued to finance the cash consideration to the equity holders of the acquired company, the fair value of the financial liability, that is debt security issued, and the financial assets, that is the cash consideration of 50 million naira, will be recognized in accordance with the provision of IAS 39 and IFRS 9 in the separate statement of financial position of the parent based on the following accounting entries. Financial liability, issuance of 10% convertible security. Debit bank and credit 10% convertible debt by 50 million naira. Financial assets, cash consideration for shares acquired in the subsidiary. Debit investment in subsidiary and credit bank by 50 million naira. The effect of the above entries is based on the assumptions that 50 million naira was raised through debt securities and the same amount of 15 million naira used in the acquisition, and that there exists zero consequence on the company's cash and bank position, assuming no transaction and issue of floating cost. The separate financial statement of the parent after recognition of the financial liability through debt issuance and investment in the financial assets through cash considerations in the subsidiary will be depicted as follows.
Now, what has happened here is that I wanted to acquire, Arsenal want to acquire Man U, 70% stake, and the worth of it is 50 million. But Arsenal does not have the cash, and Man U only demand cash. What can you do? It's that you can structure a contract and say, okay, let me issue debt, let me issue bond, let me go to bank and borrow 50 million naira. At the point you borrow 50 million naira in the bank, you've created financial liability. Your bank position will increase because they will give you money, cash flows into your bank, and you recognize a liability for that amount. But the same cash is not going to be idle. You now issue check to pay the existing shareholders of Man U, and you have created financial assets. And by doing so, what do? You recognize investment and you reduce your cash position because money has gone out. Now we assume here that there's no transaction cost. Therefore, the money that came in 50 also went out 50, which means the net effect on bank is zero, all things being equal, which means what necessarily remains is that you recognize increase in your investment to 50, you recognize increase in your cash, but later a decrease in cash, 50 in, 50 out is zero effect. and you recognize non-current liability because you are now owing 50 million for the acquisition of Manchester United, 50 million. And that is what we have in this case. Does that make sense? Does it make sense now?
Yes, sir.
Okay. Any other question? Any other question? Okay.
Question, please.
Okay.
For the second consideration, for just the consideration with payment with shares, at the point the market value was 1.25 kobo, and they said the worth of the shares that can exchange for that investment is 40 million shares. What if the shares as well, the market value of that shares is also at 1 naira, which is the nominal value of the shares already? What would have happened? Because it would have been 40 million against 50 million.
That means they won't issue 40 million, they will issue 50 million shares.
Okay, it's as a result of the fact that they know that the market value of that investment is 1.5.
When you issue shares, you issue shares at market price.
Okay.
And that will determine the number of shares you will issue.
Okay. Okay, clear, sir.
Now, the last aspect of it is deferred or contingent consideration. And I want Segun to read it through. And once you finish, I will now come back to explain it and demonstrate it.
Okay.
Let's read this carefully and I'll explain what it is.
Okay, scenario E, deferred or contingent consideration. The concept of contingent consideration and deferred consideration can also be evaluated as a consideration offered by the investor to the investee, which requires further considerations being made at a future date. Scroll up, please. Deferred consideration involves an agreement made that requires part of the consideration for the business combination be paid in the future without any condition being attached. That is, it is a consideration that will be made in the future with certainty. While contingent consideration is the future consideration, which is based on the occurrence or non-occurrence of future uncertain events that possibly exists based on attainment of some level of performance or targets by the acquired company, sometimes into the future. A special case may involve contingent consideration that requires the parent, after the payment of the sum of 10 million naira cash, to acquire the shares of the subsidiary, but the contract may be subject to a clause relating to contingent consideration, which stipulates that if certain criteria are met in the second year of ownership, relating perhaps to performance in terms of profitability, a further 2 million naira will be payable to the former shareholders of the subsidiary. IFRS 3 revised requires where an element of consideration is contingent on future events, the element should be included in the overall cost of acquisition without considering further whether it is probable. Unlike in the previous IFRS 3 that requires the adjustment or inclusion of contingent consideration only if the condition is probable, that is, chances of more than 50% of its occurrence, but must be able to be measured reliably based on its fair value. The fair value of contingent consideration should be measured based on the present value of future consideration payable, which is determined based on the investor's order rate, that is, cost of capital, or acquisition date fair value of the equity instrument transferable. Some changes in the fair value of contingent consideration or deferred consideration that the acquirer recognizes after the acquisition date may be the result of additional information that the acquirer obtained after that date about facts and circumstances that existed at the acquisition date. Such changes are considered measurement period adjustments in ascertaining the real amount of goodwill. However, changes resulting from events after the acquisition date, such as meeting an earnings target, reaching a specific share price, or reaching a milestone on a research and development project, are not measurement period adjustments. The acquirer shall account for changes in the fair value of contingent consideration and deferred consideration that is not measurement period adjustment as follows. A contingent consideration or deferred consideration classified as equity shall not be remeasured and its subsequent settlement shall be accounted for within equity. B. Contingent consideration and deferred consideration classified as an asset or a liability that one is a financial instrument and is within the scope of IFRS 9 or IAS 39 shall be measured at fair value with any resulting gain or loss recognized either in profit or loss or in the comprehensive income in accordance with IFRS 9. 2. Is not within the scope of IFRS 9 and IAS 39 shall be accounted for in accordance with IAS 37 or other IFRSs as appropriate. Technical note: the accounting treatment of deferred consideration and contingent consideration is the same based on the revised IFRS 3, which no longer require the payment of contingent consideration, which no longer require the payment of contingent consideration to be probable before it can be recognized as part of the fair value of the consideration upon acquisition. The technical difference in the treatment of deferred consideration and contingent consideration is not at the point of initial or subsequent recognition, but at the due days of the payment, which requires the derecognition. Can you scroll up, sir, or go to the next page? Which requires the derecognition of the liability for contingent consideration in the condition of his payment if the condition of his payment no longer exists as at the date of payment. Where contingent consideration involves the issue of ordinary shares, there is no liability or obligation to transfer economic benefits recognized in this as part of the equity under a separate caption representing shares to be issued.
Okay. Apart from Shegun, who can explain what he has said so far? The floor is open. Who can explain? I'm waiting.
Okay, let me try up to a bit and maybe someone will assist me further from there. So deferred consideration and contingent consideration were explained earlier. Deferred consideration being the kind of consideration that there is no occurrence or event, possible event. Oh, sorry. Let me restate that again. Deferred consideration now is a kind of consideration where, for example, payment is expected to be made at a future date. Okay. while contingent consideration is a kind of consideration where consideration will be made upon the occurrence or non-occurrence of a particular event in the future date. So IFRS 3 revised then further identify how these will be recognized in the book. So I think I missed something from the recognition part, but I understand that the requirement is that contingent consideration should be recognized at the date of transaction, which is maybe the date of agreement. But I think I missed those exceptions from there. I don't know if someone can.
Okay, who else will take? Who else? Nuruddin?
Just like Asama explained, I will take it up from where he stopped. For contingent consideration, IFRS 3 make provision that to recognize contingent consideration initially, we are going to measure that at least it's the occurrence will be at least 50% probable that it will occur in the future. But the revised edition now proved that we should not even look at whether it will occur 50%, but we should recognize the contingent consideration from the inception of the transaction. And meanwhile, the difference in the revised and the previous provision will now be at the future dates when whether we are going to recognize or de-recognize the consideration. Thank you.
Okay, who else? Anne, what's your contribution?
Nothing, sir.
Ma'am?
Sir, nothing.
No contribution?
Not at all, sir.
Okay, Mr. Yadele. Mr. Yadele. Mrs. Tomilayo.
Good evening, sir. My only contribution is I'm not sure I'm clear on the recognition part, but just differentiating between deferred consideration and contingent consideration. To my understanding, deferred consideration is a consideration whereby it will be recognized when the payment will be made at a future date. While contingent consideration is only when that particular event occurs, that's when it will be recognized. So I'm not sure if I'm clear on the recognition part. That's my understanding of both the deferred and the contingent consideration.
Okay, Madam Grace. Madam Grace.
Yes, sir.
Yes, your contribution, ma'am.
They've said so many. Well, they've said so many things about it, and my own input is just like Tommy have said, that deferred consideration is a consideration that is deferred till the time of payment, while the contingent is the occurrence of the event, at the occurrence of the event. So it's just like, you are doing it in the future when it happens.
Okay. Olawale. Olawale. Okay, is an arrow there? Okay, Mr. Ayodele is back. Mr. Ayodele, can you contribute? Mr. Ayodele, are you there? Okay. Now, I will explain what it is, but I want Shegun to read the question before I proceed.
Cash consideration of 50 million naira offered.
Hello, sir. The network is very bad here. I can barely hear you.
Okay, no problem. Mr. Shegun, continue, sir.
Cash consideration of 50 million naira offered the shareholders of the acquired company, and also agrees to pay a further 10 million naira on 30th July 2016 upon attainment of certain performance in the next 2 years, as shown below. The given information that as shown below, and given information that the investment in the financial asset is yet to be accounted for in the separate financial statements of the investor. Assume the parent order rate or cost of capital is 12%. Parent PLC, statement of financial position as at 30th June 2014. Property, plant and equipment, 300 million. Current assets, 120 million. Total assets, 420 million. Share capital and reserve. Equity share capital at 1 naira per share, 250 million. Reserves or retained earnings, 90 million. Current liabilities, 80 million. Total equity and liability, 420 million. The fair value of the entire consideration upon the acquisition will have to be recognized
Stop there.
in the separate financial statements of the.
Okay, can we stop there?
Okay.
Okay. I've copied the question. Let me share my slide with you. Accounting for deferred or contingent consideration. In a business combination. Okay. Now, let's break it down first. When we say deferred consideration, what are we talking about? We are talking about a part or portion of the purchase consideration in a business combination that is required to be paid in cash or delivered in shares or deliver any other form of financial asset or asset, as the case may be, to the former shareholders, which we also know as owners of the acquiree, which in this case is the subsidiary. At a later date or future date. Now, what do we mean? If, for example, Segun, which is Arsenal, has agreed to buy 70% stake in Man U for $100 million, but you have delivered whether cash, whether shares or whatsoever to the tune of $60 million. And you have agreed in principle for you to pay the balance of $40 million, either in cash or in shares or in any other asset form in a year time or in 2 years time or in 4 years time. The portion that you have deferred, which is 40 million, is what we know as a deferred consideration, which means is a portion of the whole purchase consideration that will be paid at a later date in cash or that will be delivered as settlement for the acquisition by way of shares in the future or by delivery of any other form of assets which could be considered money terms in the future. That portion of 40 that represents the balance out of 100 million is your deferred consideration. But it becomes a contingent consideration whereas a contingent consideration is a deferred consideration in quote that is subject to future conditions of an uncertain event. What does that mean? Defer means that it is what you are also likely going to pay in cash or deliver in shares or settle in any form of asset, whether financial or non-financial, at a later date, but of which the amount you pay at a later date is dependent on certain conditions, whether they exist or not, whether they are met in full, in part, or not. Which then means that if, for example, you propose to buy Manchester United for $100 million, and in the consideration, the owners of Man U says, no, it is $120 million. And he said, no, the worth should not be more than $100 million. Two of you enter into a negotiation and you reach an agreement. And such an agreement is such that you agree to say, okay, I will put down my $100 million today, and I will pay you $20 million to balance it up in 2 years' time, provided Manchester United wins the Champions League in the next 2 years. What it then means is that if Manchester United wins, I am bound to pay $20 million. If they don't win, agreement will say I'm not going to pay the $20 million. Therefore, it means it's no longer a certain consideration deferred into the future. It has become an uncertain consideration deferred into the future, which makes it a contingent deferred consideration. And in simple terms, we call it a contingent consideration. So that when you attain that Champions League in full, you pay the 20 to balance up. When you don't win it at all, and you don't win any premiership, you don't win anything, you pay nothing. Or the term says if you don't win Champions League, but you win premiership, you pay half of it. You know, these are conditions and terms that make it contingent. And the word contingent is payable in full, or it's not payable at all, or it's payable in part. And that's what it means. Now, regardless of whether it is deferred consideration or contingent consideration, the accounting treatment at acquisition remains the same. And what does IFRS 3 say? It says, upon acquisition of a subsidiary or upon acquisition of an acquired or a target entity, once you have a deferred or contingent consideration, such will be recognized at their fair value as at that acquisition date. The question then is, what is the fair value of different kinds of consideration? What is the acquisition date fair value of these considerations? If it is to be settled in cash, if settlement is in cash, which is in the future, what you look for is the present value of the cash flow of the future cash flows, which means I am to pay 20 million in 2 years' time. Let me discount the 20 million from 2 years' time back to today. That will represent my fair value. If settlement or delivery is in shares, the fair value will be the market price of the shares. And if it's not an active market, it will be the valuation price, which is an intrinsic value, which can be measured based on different metrics, as you know, under corporate finance or strategic financial management. If settlement or delivery is in other form of what? Assets. The fair value will be determined relatively to the nature or class of such what? Assets. Now, what does this mean? It means shares are not necessarily determined by way of present value. First, if it's a quoted company, the market price is readily available, which represents the level 1 fair value based on the hierarchy, which we'll discuss further when we get to IFRS 13 on fair value measurements. But if it's cash, you look for the present value of cash, because £1 you pay me today is not £1 you pay me in 2 years' time. What is the worth of £1 you pay me in 2 years' time today is for me to discount. And the sum of the value of the discounting is what gives my present value. While for other assets, the nature of the asset to determine whether it's going to be present value or it's going to be obtained based on market prices or it's based on current cost, as the case may be. Probably if you are to defer and give me land, what is the current cost of the land, which is the marketable value of the land today? Or if it's property, or if it's a movable asset. These are things you need to take into consideration. Now, let us now use that to explain the problem at hand. The problem at hand, from what you have read here, it says that upon the acquisition, you paid a 50 million cash consideration to the shareholders of the acquired company and also agrees to pay a further 10 million on July 30th, 2016, whereas the acquisition took place in 2014. Remember, we are still using the same question we had here. Let me share the screen. The same question we had here when we started from cash consideration. Can you remember? From cash consideration, the same question here. Okay, now what you have said here is that a cash consideration offered to the shareholder is this, and they have produced the financial statement of the investor as at the time you purchase, and there was no investment there. We are now saying that, okay, if you pay cash of 50 million instantly, and you have to pay 10 million in 2 years' time, by the time we compare these two dates, how much should we now recognize as the fair value of the purchase consideration as at the date of acquisition? Is it 50? Or is it 50 plus 10, which is 60, or what? Who will answer me? Who will answer? I'm waiting.
Okay,
yes,
it is 50 plus the present value of the future cash flow. That is present value of 10 million. 50 plus present value of 10 million in 2 years' time.
Look at it too. Today, date of acquisition. You pay 50. In 2 years' time, the 50 will have grown to 60 as your full payment. Why? Because within this period, you will have paid plus what? Plus 10 million. Is that not? Therefore, what you have said is that you should find that you are not going to pay 60, neither are you, no, you are not going to recognize 50, neither will you recognize 60. Is that what you said?
I said we pay 50 plus the present value of the 10 million today.
Which means your value is not 50, neither is it 60.
Yeah, it's not.
It is in between 50 and 60. Madam, Oya, what's your own view?
That's my contribution to 50 plus the present value of the cash flow that we're supposed to pay.
Which means in this case, if you pick 50, you are totally wrong because you didn't capture all the consideration. You only captured the one that was paid. If you pick 60, you are wrong also because you have captured the value of the present and you have added it with the value of the future. Apple and orange cannot be summed together. Therefore, what we need to do is that neither are we going to recognize 50, nor recognize what? 60. But our purchase consideration or price as at acquisition what? Date should approximate, okay, I think all figures are in millions. The cash consideration, which is immediate, how much? 50 plus the present value of the deferred consideration, which is X or none. The question then is, what is the present what? Value of the deferred consideration. Remember, how do you determine present value? Today, and this is the future. In the future, you want to pay 10 million. And between the future and today is 30th June 2014. The future is 30th June 2016. In between it, you have 30th June 2015. Which means between this is year 1, and this is what? Year 2. Now to find what my X is here is for me to discount this 10 million back to 2015, which is the first time I'm discounting. And because that's not my final destination, I discount back to what? 2014, which is, I'm doing it for the second time. Which means invariably, what am I doing is for me to say my discounted value, which is my present value, will be my future value discounted by my cost of capital or discount rate raised to power n. N is the period of my discounting. Which means in this case, I'm saying that the 10 million naira should be discounted from 2016 to 2014 with my order rate. What is my order rate? My order rate, which is my cost of capital, is 12%. And that means I'll discount it back with 12% for how many years? 2 years. How do I get 2 years? I'm to pay this in 2 years' time, and I'm now bringing it back to today. This is similarly known as saying 10 million multiplied by 1.12 raised to power minus 2. Remember the principle of indices. And approximately, whether I do it as what I have before or now, what I should get is what I got, which you can confirm, is 7.97 million. Is that what you got?
Yes.
Okay, which means my X is 7.97 million, which I'll come here to say my X equals 7.97, which means all what I'm recognizing is 57.97 million. And to do that means that my accounting entry when I made this acquisition is to recognize investments in subsidiary to the tune of 57.97 million. And to recognize that I pay cash to the tune of 50 million. And I am owing by way of deferred consideration, which is a non-current liability of how much? 7.97 million. This is what happened at the point of what? Acquisition. And that is what we try to do here. Does it make sense, please? Does it make sense?
Yes.
That is why, upon doing this, this is how our balance sheet looks like. Do you see how our balance sheet looks like? Any question? Any question? Which means here, investment in subsidiary come up to 57.97. Current asset depletes by the cash position that we paid out. And our non-current liability surfaces with our consideration that was deferred into the future. Now, the next order is this. Because we have recognized a non-current liability that has an implied discount rate of 12%, which is our ordinary rate or cost of capital, what then happened thereafter up to the date in which we will now settle? What then happened thereafter up to the date in which what we settle? That will lead us to the principle of unwinding discounts. Principle of what? Unwinding discounts. And this only applies when we deal with a situation of cash, because that is what we measure at present value. Anything you measure at present value and you are moving forward, you need to unwind the discount by way of recognizing a finance cost. By way of recognizing what? A finance cost. Now, how do we do that? That is the next order before we call it a day. Can you read this for us? Read from technical notes to this point here. I'll highlight it.
Excuse me, sir. Excuse
Yes,
me,
sir.
Please, let me not die in silence, please. I have forgotten the way we do that raise to power, please.
Okay.
To raise a power when discounting.
Let me show you. This one, you have to pay for it.
Okay, sir.
Law of indices. When you have 1 over x raised to power n, it's the same thing as x raised to power minus n. Now, when you discount cash flow for a single period, it is the same thing as 1 over 1 plus r raised to power what? N.
Yeah.
I'm coming, my barrel is. Okay. Raised to power what? N. Okay, this is the same thing. It's an equivalent of saying, bring the denominator up and the power of the denominator become negative. This is what we did. You can say now. And that is what happened here. Say 10 million over 1 plus 12% raised to power 2. It's saying, when you say 10 million over 1.12 raised to power 2, it's the same thing as saying 10 million naira on one hand multiplied by 1 over 1.12 raised to power 2, abi? Now, I can now say 10 million naira on one hand multiply, if I look at this, it's the same thing as this. Therefore, I want to convert it to this. It will now be 1.1 raised to power minus 2. That is where we got it here. Does it make sense now?
Yes, it makes sense. It is at that point of using the calculator, that is where I didn't get, sir.
It depends on the calculator you use. Okay? You have your calculator I'm using is a financial calculator. The methodology here is different from the one you have. Okay? Like the calculator you are using. Okay? Let me give you a clue. Just show me that calculator as I'm seeing it here. Okay? I should guess this is Casio, but this looks like cheap one. Okay. Okay, what you do there is I press 1.12. Press 1.12. You see one of those functions there that shows like arrow facing up, raised to power, or you see y raised to power x. Did you see that?
That's what I didn't see. That's what I didn't see. But don't let me not drag the class back. I will look for it. I get what you're saying.
I do it is this. 1.12 raised to power 2 is like saying 1 divided by 1.12 and you do it 2 times. Press 1 on your calculator.
Huh?
Press 1 on your calculator.
Okay. 1
divided by 1.12.
Divided by 1.12.
What does it give you?
That's 0.89 the first time.
Divided by another 1.12 the second time.
0.7971.
That means you have done that discounting 2 times. That's what it means. So you multiply by the 10 million. Or 10.
Thank you. Thank you.
But the danger there is that if it's 20 years, you have to press calculator 20 times.
I know, I've forgotten that function. Thank you. I'll get it. Thank you, sir.
Okay. Let me clean this up before your people will see that daddy, uncle doesn't know indices. Okay, can you proceed? Mr. Shegun, can you proceed?
Okay, sir. Technical notes. The contingent consideration is treated in accordance with the provision of IFRS 3 revised, which requires the present value of the consideration to be considered as part of the cost of investment. And equally, the corresponding credits or liability is treated in line with the position of IAS 37, which is regarded as a provision for non-current liability as the consideration is payable in cash in 2 years' time, but would have been recognized as current liability if the consideration is payable within 1 year. Kindly note that if the contingent consideration is payable in equity shares, IAS 39 or IFRS 9 will be applied and such equity value is not to be remeasured. Assuming 1 year after the acquisition of the subsidiary, the further implication of the acquisition date recognition principle will be the unwinding of the discount inherent in the contingent to profit or loss, that is income statement of the group, and simultaneously recognized an increase in the liability for contingent consideration as shown below. The unwinding of discounts is on contingent consideration, debits consolidated income statements, and credits liability contingent consideration by 0.96 million naira. The discount unwound is determined based on the increase to the present value of the contingent consideration measured 1 year after the acquisition as calculated below. Unwinding of discounts, 12% times 7.97 million naira will give us 0.96 million naira, or alternatively, contingent consideration measured at a year after, that is 10 times 1.12 raised to power minus 1, gives us 8.96 million naira. Contingent consideration as measured at acquisition date, 7.97 million naira. Discount unwound equals to 0.96 million naira. The implication of the unwinding of discounts of the approximate sum of 0.96 million naira is that group profit is charged with the finance cost, being the discount unwound, and the group liability towards contingent consideration increases to 8.96 million naira, that is 7.97 million naira plus 0.96 million.
Okay, thank you. Now, what we are saying is this. Since we had recognized the present value of the deferred consideration at acquisition date, then a year after, that is 30th of June 2015, what will be the implication? And let me enlarge it. What will be the implication? I'll draw a diagram again for better understanding. Now, this is now yesterday. Yesterday was 30th June 2014. And this is the future. 30th June 2016. Now, this is today. You know, a year has passed now. Today is 30th June 2015. What it simply means is that yesterday has gone. Okay? This is where I am now. S, which is a question mark. Now, yesterday, remember this was 7.97 based on what we did, Abby. But today, we want to know what X is. But we know that the future is 10 million. Therefore, the question is, this 10 million, how many times are we going to discount it back to this place? Once. What that means is that, okay, what is my present value of the deferred consideration on 30th June 2015? Is for me to discount this 10 million back just 1 year. And doing so, give me how much?
$8,928 or something.
It will give me approximately 8.93 million, which means my X here is 8.93 million. That's my X here. Alternatively, I can easily compound this 7.97, and when I'm moving forward, it's +1. When I'm moving backward, I'm retracing my step. When I'm moving forward, I'm counting new steps, have you?
Yeah.
Therefore, it means I can equally say the present value of my deferred consideration as at 30/6/2015 is my value in year 1, which is compounded by my cost of capital just for 1 year, which means 7.97 times 1.12 raised to power 1 is still going to give me the same thing, because there's a relationship based on theory of interest that exists between the principle of compounding and the principle of discounting. Now, what this simply means is that this 7.97 has increased to 8.93. By how much? It has increased by 8.93 minus 7.97. It has increased by 0.96. The question then is, what is 0.96? 0.96 is the finance cost. That is, what you've unwound from the discount embedded in the present value. Because every present value has discount embedded in it. And how do we do that? You do it in 2 ways. Approach 1 is to find the difference between the present value in 2015 and the present value in 2014. That is 8.93 minus 7.97, will give us 0.96. Or you use the second approach, which says your finance cost is equal to the cost of capital, which is 12% times the present value in 2014. That is 12% times 7.97. will give you what? 0.96. Now, how do you treat a finance cost? The treatment of a finance cost is you debit your profit because of it's a finance charge, and you credit. Because this is not paid for, it's just a mere unwinding of discounts. Where was the discount sitting before? The discount was sitting when you recognize deferred consideration, which was a liability. It is this entry that made our liability to increase from 7.97 in 2014 to 8.93 in 2015. And that is what we have done here. And that is what Shegun read in the material. Any issue about this? Any issue about this? Does it make sense now?
Yes, sir.
Therefore, that means you can relate it to what you found in this material.
Question, sir.
Yes, sir.
Okay, sir. Are we to, from what Shegun read, from what I could hear I'm reading, is that it's on the condition that if the deferred consideration is 1 year, that's where we can determine the finance cost and recognize the expenses and all that. So in this situation of questions, or in this situation of question we are treating, he said the deferred consideration will be in 2 years' time. So is it that
you didn't get it right?
Sir?
You didn't get it right. What we said is this: you are doing payment in 2 years' time, and you can't jump to the second year. You must still pass through the first year. Now, at the end of the first year, what is the implication of what you have done in 2014 that you are going to settle in 2016? What is the implication in 2015? That's what we are talking about. Your recognition of 7.97 is more or less like you borrow 7.97 million from bank at the rate of 12% interest. Which that means that at the end of year one, won't you account for your interest, which will grow the liability?
Okay.
Do you get what we are saying?
I'm getting it.
Will the liability remain the same between 2014 and 2015?
No.
When it attracts interest at ordinary rate of 12%?
It will.
What do you do there? You determine the interest amount and charge it to your profit or loss and use it to increase your liability. Is that not?
Yes.
Yeah, that's what we've done.
So what of in the year where the consideration will be paid?
We have not got
okay. So our account is based on as at the date of acquisition.
No, we are missing it up. We are past date of acquisition. Remember, at one point in time, we were at the date of acquisition. A year has now gone. We are in another date, which is 2015, and we are not yet at the settlement date. You can't jump from 2014 to 16. You must still pass 2015. The question is what you have done in 2014. What is the consequence of it in 2015 before you even get to the settlement date?
Okay.
Let us think from the perspective of practice. Don't let us think from perspective of exam. We are talking of you did something. Anything you do last year will have effect on you this year, up to when the effect will zero out.
Okay.
Okay? Yeah. I want you to read more. We have dealt with the day of acquisition. We are dealing with a year after acquisition, and we'll deal with it up to the final date where settlement has taken place. Okay. Mr. Shegun, continue from where you stop. We've dealt with the date after the date of acquisition. Now we want to deal with the final day, which is the settlement date.
Okay, sir.
Continue from there.
Furthermore, at the end of the second year, there are two possible outcomes, which include the condition attached to the contingent consideration is being attained, and secondly, the condition attached to the contingent consideration is not being attained. If the performance, which is a condition attached to the contingent consideration, is met, the discounts unwound in the sum of 1 naira 7 kobo, 1.7 million naira, as determined below, will be availed the same treatment as earlier displayed and as shown below. The unwinding of discounts on contingent consideration, debit consolidated income statements, and credit liability, that is contingent consideration, by 1.07 million naira. The discount unwound is determined based on the increase in the present value of the contingent consideration, measured 2 years after the acquisition, as calculated below. Unwinding of discounts, 12% times 8.93 million naira, which gives us 1.07 million naira. Alternatively, contingent consideration measured 2 years after, that is 10 million naira times 1.12 raised to power 0, gives us 10 million naira. Contingent consolidation measured at year after, which is 8.93 million naira. Discount unwound equals to 1.07 million naira.
Okay. Now, the same thing we did there, we replicate it. Okay. This is accounting effects. Accounting effects sorry, something's wrong with my marker. Okay, I don't know What is wrong with the writing device? Let me relaunch it. Okay, I think it's back. Okay, accounting effects at year of settlement. Now, what will I do? I'll rub everything up. The date here. Okay. Okay. That means the present value as of today, which is 2 years' time, is 10 million discounted by 1.12. Now, go back to it. Look at this date carefully. 30th of June, 2016. It's exactly the same thing as our future date, which means the present has a convergence with the future. You understand? Which means the present will always move towards the future and they'll meet. And at the point they meet, there is no period you are looking back to, which means everything there is zero in terms of period. Therefore, it means you are not going to discount it by 1 or 2 by 4. It has come to what? Is 0. You know, we started from -2. to minus 1. And today they've met. And anything raised to power 0 is what? 1. And 10 million divided by 1 is what? 10 million. And that is how we arrive at that. Alternatively, it is the present value of DC, which is based on the present value in year 5, that is in year 2, multiplied by 1 plus 12% in year 1, which means in this case you have, what is year, sorry, in year 2 now. This is year 0, sorry. Now this is year 1. Now what is present value in year 1? 8.93. I'll come here, 8.93 times 1.1 to raise to power 1 will equally give me 10 million. Or my present value in year 0, discounted for 2 years, which means my present value in this year, 7.97. To get to this level, I compound it year 1, compound it what? Year 2, which means my compounding here is 2 times, which is 10 million multiplied by 1.1 to raise to power 2. You still, 7.9 million. $7.97 million multiplied by this will still give me 10 million naira. Which means regardless of how I do it, I get 10 million. Which means I've now converged to the future date. Now doing so, what is my finance cost? Is the difference between the present value in 2016 and the present value in 2015, which means difference between the 10 million and the 8.93 million, which will give me 1.07 million. Or my cost of capital multiplied by my present value in 2015, which is 12% multiplied by 8.93 million. And that will still give me 1,000,007. Invariably, what is my accounting entry? Is to recognize my finance charge and recognize my contingent consideration. The recognition of 1.07 on this 8.9 is what now make me to have fully accounted for my 10 million, which I will now have to pay at the end of the year or the next day, which is the beginning of the year. Which means unwinding of discount is a process of going back from the present value to the what? Future value. Which means invariably the entire difference between 7.97 and 10 is what has been recognized in each of the periods as 0.96 in year 1 and 0.07 in year 2 for the purpose of accounting for finance costs. And that is what I believe Shegun read from that solution that was presented. Any question at this point?
So, sir, this is not a question. I just wanted to reiterate that. So it is that finance cost now that goes into the P&L for each year, thereby using it to increase the debt in the liability side. Am I?
Yes, sir. And now you can go ahead. You can go ahead. You are muted. And now you are muted. Oh yeah. We can't hear you. We can't hear you. Okay, I think we'll move ahead. Except you send your question by chat. I think there's a problem from your side there. But you can ask your question on the chat and I'll put it up. Okay. Now, what happens on settlements? Settlement will just be mere accounting entry. Okay, Shegun, can you read up this? Now, when we are now to pay the 10 million, how do we account for it? You start from here.
You are yet to share your screen.
Oh, I thought I'm sharing my screen already. Sorry. You know, you have to be alert. Most times you don't know. It's not easy. It's not easy. Okay, go ahead.
Okay. Where the performance is not achieved has been set upon acquisition for the subsidiary, the amount of contingent consideration may be reversed in total or partly based on the proportion of the condition met as may be agreed in the contract, and will be treated as a change in accounting estimates based on IAS 8, accounting policies, changes in accounting estimates, and errors, which requires a reversal to the income statements of the group at the date the contingent consideration becomes no longer payable in full or in part, which implies relevant portion being derecognized as a liability of the group as at 30th June 2016. In this case, and where the full amount is derecognized, the following accounting entry is required. Debit liability, that is contingent consideration, by 10 million naira, and credit group profit by 10 million naira. Technical note: the fair value of the contingent consideration at acquisition could be different to the consideration transferred, and any difference are normally treated as a change in accounting estimate and adjusted prospectively and not retrospective in accordance with IAS 8. Tabular appraisal.
No, leave that. Yeah. What we are simply saying here is this. Unlike the question we just solved, I treated it separately as a deferred consideration. Therefore, there's nothing like contingent there, which means what happened is that upon settlement, this is the entry that will be passed. Upon settlement, that is payment of cash to extinguish the deferred consideration as a liability. The entry you pass will be to debit your deferred consideration, which is your liability account.
Yes.
Because it's no longer required, it has been discharged, and you credit your mode of payment, bank, with how much? With the 10 million. This is what you should do naturally for deferred, because it is certain you must pay. It's just by way of passage of time. Okay, but this is not what the situation will be. This is not what the situation is when it comes to contingent consideration. If the conditions are met under contingent consideration, the treatment we give deferred consideration, which you just left, is the same treatment you give, and everything move on. But the condition then is that, let us assume the conditions was not met at all. and you have already accrued for an obligation of the sum of 10 million. What are we going to do? Are we going to leave the liability there since it's no longer payable? What is the requirement of the conceptual framework about the recognition of an element? Is that once liability has been extinguished, and a liability can be extinguished by way of discharge, but in this case, it's not discharge because you are not to pay. A liability can be extinguished by way of cancellation, which is by the order of the court. And a liability can be extinguished by way of when it expires because it's no longer required. And the third one is what happened in this case. The condition was not met, therefore, such payment is no longer due to the original shareholders in which I took over the company for. And therefore, what the standard says, such will be written back. A reduction in such a liability that does not amount to payment of such liability is regarded as what? An income, because an income can be considered as a reduction in liability that brings about increase in what? Equity, other than distribution or additional contribution made by any equity participant. Therefore, in this situation now, what do we treat? We treat it as a profit, which means reversal of earlier provided, what's it called? Provision for contingent consideration. But if the liability, if the condition is met in part, based on our agreement, it might be half of it that we recognize as profit. It might be 10% of it, depending on what the agreement says. And if the condition is met in full, all of it will be recognized in the books. Does that make sense? Okay. Now, all of what we have done, if you remember, is on the premise that we are dealing with cash as deferred consideration. If the deferred consideration is in shares, if the deferred consideration is in shares, in that situation, we are not going to do present value. And I think I've explained that. Rather, what are we going to do is to find the market price of the shares. And in that case, you are not going to do unwinding of discount when it comes to shares or equity. What you are going to look at is that the condition has it changed such that it affects the measurement of equity, not with respect to the equity price, but with respect to the quantity of equity that will be delivered. And that is why when you come here, which is where we stop for the day, before I come to the summary, which is tabulated here, there's something Segun read that I believe has not resonated to most of us. You make mention of something here. Can you read this again? Segun, can you start from this, please?
Okay. The acquirer shall, okay, let me wait.
Oh, yeah.
Okay. The acquirer shall account for changes in the fair value of contingent consideration and deferred consideration that is not measured, that is not measurement period adjustments as follows. Contingent consideration and deferred consideration classified as equity shall not be remeasured, and its subsequent settlement shall be accounted for within equity. B, contingent consideration and deferred consideration classified as an asset or a liability that, one, is a financial instrument and is within the scope of IFRS 9 or IAS 39, shall be measured at fair value, with any resulting gain or loss recognized either in profit or loss or in other comprehensive income in accordance with IFRS 9. 2. Is not within the scope of IFRS 9 and IAS 39 shall be accounted for in accordance with IAS 37 or other IFRSs as appropriate. Technical note: the accounting treatment of deferred consideration and contingent consideration is the same based on the revised IFRS 3, which no longer require the payment of contingent consideration to be probable before it can be recognized as part of the fair value of the consideration upon acquisition. The technical difference in the treatment of deferred consideration and contingent consideration is not at the point of initial or subsequent recognition, but at the due date of the payment, which requires the derecognition of the liability for contingent consideration if the condition of his payment no longer exists as at the date of payment. Where contingent consideration involves the issue of ordinary shares, there is no liability, that is obligation to transfer economic benefits. Recognize this as part of the equity under a separate caption representing shares to be issued.
Okay, now use this table to wrap it up.
Okay, sir.
Let's use this table to wrap it up.
Okay. Tabular appraisal of investment accounting in separate financial statements. 3 headings: mode of consideration, fair value measurement, accounting entries in separate financial statements of the investor. 1. Cash consideration. The fair value measurement is amount of cash. The accounting entry is debit investment in subsidiary and credit cash and cash equivalent. When the mode of consideration is share exchange, the fair value measurement is current market value or its equivalent measurement of fair value for unquoted equity. The treatment is to debit investment in subsidiary, credit ordinary share capital, and credit share premium. When the consideration is deferred cash consideration, we use fair present value of the amount of cash based on time value of money, and the treatment is to debit investment in subsidiary and credit liability. When the mode of payment is deferred shares transfer, the measurement is current market value or its equivalent measurements of fair value for unquoted equity, and the treatment is to debit investment in subsidiary and credit other component of equity, that is deferred shares reserve. When the mode of consideration is contingent deferred cash consideration or contingent deferred shares transfer, the measurement is nevertheless on how probably the occurrence of the uncertain event, the considerations are required to be measured at its fair value at acquisition dates. And the treatment for contingent deferred cash consideration is to debit investment in subsidiary and credit liability. The treatment for contingent deferred shares transfer is to debit investment in subsidiary and credit other components of equity, that is deferred shares reserve. Okay, when the mode of payment is tangible assets transfer, then the measurement will be fair value of the asset transferred, such as raw land or properties. The treatment will be to debit investment in subsidiary and credit disposal of assets, which the fair value of the assets transferred, and debit disposal of assets and credit assets, that is the property, with the carrying value of the assets transferred. When the mode of payment is debt consideration, the measurement is proceed on issue of debt if issued to third parties, or agreed exchange value of issuing debt to existing shareholders of the investee or subsidiary. And the treatment is to debit investments in subsidiary and credit financial liability, that is debt obligation.
Thank you very much. This summarizes all what we have discussed so far today. And I believe you going back will more or less give you more avenue to have better understanding. If there's any other question, we can put it to the floor. Otherwise, we'll call it a night. And until we meet next week Saturday again. Thank you.
Yeah, I just have one question, please.
Okay.
Like where we did the calculation of the unwinding of discounts and other relevant calculations. Like in practice, do we put all those things in the notes to the financial statements?
Yes, they are relevant section of it. And that's why one of the tasks I'll give to you is to pick financial statement of 2 companies or more in Nigeria, and pick also foreign companies that is a group, and let us look at them. You will study them. I'll try and bring some other ones, and we're going to see how we disclose all of this, if any, in the group accounts. Okay. Thank you very much, and God bless you.